But first, you really have to understand who you are. It really starts with you. What is your value proposition? What is your skill set and strength that you can bring to an opportunity or a partnership? And then once you've identified that, that's what you need to go be announcing to the world and the community.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we are going to jump into being competitive in this market. Well, what dynamics should you be watching and looking for? How do you understand your current local market dynamics and fundamentals? What do you need to know so you're making the right purchase and for you and your investors? Well, today, our guest, Cody Laughlin, we're going to jump into that. He is an expert in underwriting and acquisitions. He's a managing partner and director of acquisitions at Blue Oak Capital, a Houston-based multifamily acquisitions firm. Blue Oak Capital has invested in $111 million worth of multifamily real estate across 847 units as general partners. In addition to his role as a real estate entrepreneur, Cody is a thought leader, proud husband, and father of 3 beautiful children. So Cody and I today, we just jump into his skill set. We talk about even some of that, about finding other team members that complement those skill sets, which I felt like was very useful, or should be for you today to build your team out. But also then we're going to go into, those market dynamics and fundamentals and underwriting, and even some creative ways of finding value at your community that maybe you haven't thought of. Cody, welcome to the show. I know you are an acquisitions expert, you're underwriting deals, and man, is it difficult in today's market, right? Is one of the most difficult things, right? Is finding those deals and making sure we're underwriting them in a way that makes sense, right? Not only for us, of course, but for our investors and our whole, our whole network, our team, everybody that's in on that project, especially our investors. It's difficult. So I'm looking forward to getting into that. Give the listeners a little more about who Cody is and why syndication and, why real estate for you.
Yeah, well, first off, Whitney, I want to thank you so much for having me on the show. This is just an absolute honor. I've been a big fan of yours, listened to your show for some time. We were talking before the show. You were even a mentor for us in getting our podcast launched. So, it's really cool to be here with you today. But yeah, I'm one of the managing partners and director of acquisitions at our company, Blue Oak Capital. We're a Houston-based acquisition firm that's focused on existing multifamily across Central Texas. And we offer investment opportunities to accredited investors looking to invest in multifamily real estate here in Central Texas. And I kind of found my way into real estate by accident. I became an accidental landlord 2010. And at the time, had no idea what we were doing. All we knew is my wife and I, we had 2 houses. We couldn't afford to pay 2 mortgages. So we put a resident in one of the houses and said, hey, we'll figure this out. And that's where light bulbs started going off. I read the Purple Bible, as I like to joke about, Rich Dad, Poor Dad. And, it was that inflection point in my life where I realized, man, my entire upbringing was misled. And, my career path maybe not have been that true path to financial independence that I was looking for. So started pursuing real estate entrepreneurship. And, after going through several different strategies in the single family space, did a little bit of wholesale, had some buy and hold, did a few single family flips. I realized, this is a hard model to scale. The amount of volume that you would have to do utilizing that strategy was going to take me forever. And when I discovered multifamily and the power of things like syndication and the economies of scale that come along with that, that was really the, transformation point for me and the pivot into going to exclusively to multifamily. And that's what we've been focusing on. That was around early 2019 and, started building the framework, started following guys like you, Joe Farrell is, somebody else that we both respect. And, really just kind of started building out a network and finding the right people to help me, build this business. And I was fortunate enough to meet 2 great partners, launched Blue Oak Capital. And today we are general partners at about $115 million worth of multifamily real estate across 847 units. And, we're looking to have a equally productive year this year. So
good for you. And I appreciate just elaborating on some of those points. And there's numerous things that stood out. But before we jump into some of the underwriting stuff that we need to be thinking about right now and that you are doing just in this competitive market, you mentioned like finding the right people to help you build this business. You listed off, a couple of folks there and speak to like how you did that, right? That can be I was just at the Best Ever conference this past weekend, actually in Denver, and I was just talking. Joe and I were just spending some time together and talking about the event, talking about business, whatever. And however, we were just talking about the different types of people that are there. Man, why are some so successful and some just they're not, right? Like I can be talking to so many people on there, and I notice some of the same people just kind of wandering around. Right. And it's hard to make that leap and actually go talk to that individual, right, that they're wanting to talk to, or they just can't build up the courage really sometimes to stick their hand out and say, hello, I'm Whitney. How are you? Right. Speak to how you found those, quote, right people that helped you to go to the next level in this business, that helped you to build, your business.
Sure. Well, it all starts with networking, as you just mentioned, right? I mean, it's being visible in these circles, in these networking communities, and just trying to meet as many people as you can. But first, you really have to understand who you are. It really starts with you. What is your value proposition? What is your skill set and strength that you can bring to an opportunity or a partnership? And then once you've identified that, that's what you need to go be announcing to the world and the community. I need to be telling people that, hey, I'm the director of acquisitions and I'm the analyst and I'm the underwriter for our team, because that's what I enjoy doing. That's what my skill set is, and then by identifying that and being intentful in your networking, you can find other people that have those complementary skill sets to now build a team. And then once you've identified those few people that, hey, here's somebody that is great at investor relations, or here's somebody that's great at marketing, or whatever the case may be, then you could start the process of going through the exercises of quote unquote dating, right? Is, hey, we have complementary skill sets, but can we work well together? And you start off by going through the process of analyzing deals together, looking at opportunities together, and making sure that those synergies are truly aligned. And after you've done that and you've built that comfort level and that trust, that's where partnerships really become fruitful and emerge. But, again, it starts with you, and then it starts with being intentful in your networking and really being specific on who you're trying to target at these networking events. How often do you see this, right? You go to shake hands with somebody and it's, hey, how's the weather? And that's it. It's kind of a dead end conversation, but it's you have to be very, very specific and intentful on what your strategy is when you're going to these networking events.
Love that. It seems so simple, but most do not do it.
It's tough. Yeah.
Most do not do it. I love how you lay out, hey, what is your value proposition? What is your skill set? I often tell people, hey, if you're brand new to this business, figure out what you love to do. There's so many different parts of this, team that has to happen, right? What do you love to do? Is it underwriting? Hey, if you hate numbers, don't pick underwriting, right? Maybe it's investor relations. Maybe you are good at networking, or if you hate it, maybe underwriting is your thing, and you just stay away from the conference and let somebody else do that, right? But you got to figure that out. But I love how you mentioned, Cody, identify what that is. What is your skill set? And then you got to let the world know. You got to let people know that, hey, this is your focus. And you talked about, then you're going to find other people that like to do those other things, right? No doubt about it. It's a very similar story with my business partner, Sam and I, very similar. So you built a team. I want to hammer on that a little bit because you mentioned it, because it's so important and people just do not do it. But I want to jump to, your skill set that we're going to talk about, and just your value proposition, which is the acquisitions, the underwriting. And because I feel like, man, right now it's difficult, right? I mean, I was just talking to somebody else and numerous people last weekend in Denver about people are buying, 60s vintage projects at like a 3 cap or, things like that. It's like, oh, hurts my head to think about that. Right. Yeah, maybe a year from now, we'll wish we'd been doing that. I don't know, but tell us, Cody, let's jump into some of your skill set and let's talk about, underwriting in this competitive market, some things you're doing, maybe dynamics we should be watching. Let's jump in.
Yeah, man. Yeah, I tell you, Whitney, to me, the underwriter or analyst in today's time probably has the most difficult job when you look at an operator or syndication team, because 2-3 years ago when I was getting started in multifamily, deals were there. Liquidity was probably harder to find. Raising capital was probably the most challenging part of the business. Whereas now there's plenty of liquidity out there, right? There's plenty of capital. It's not very hard to find. But as an underwriter and an analyst, it's very hard to keep up with the pace and the accelerated asset valuations that we're seeing across, most of your major markets here in the country. And so the needle's moving every single week, every single day, it feels like. And there's multiple factors that are playing into that. But, I think now more than ever, and it seems rudimentary when I say this, but understanding your market fundamentals and market dynamics is so crucial right now. I'll take Houston, for example, where, historically Houston's been a organic rent growth of, let's call it 2%, maybe 3% on a good year, consistently year over year, where last year we saw 16% rent growth, most of which was in A class. And then we saw this massive absorption here in Houston. And so on face value, that looks awesome, but you really need to understand what's driving that. What are the underlying factors that are contributing to these changes that we're seeing in the marketplace? Because we all know that those type of rent growth, those absorption rates, those are not going to be sustainable. We're not going to see that replicated year over year for the next 5 years. I wish we would, but it's just not. So I think understanding market dynamics right now is so crucial and pivotal. But, when it comes to underwriting, our job as underwriter and analyst is to precisely, and that's the key word, precisely determine what value should we acquire this asset at and give us an opportunity to execute our business plan and still make reasonable projected returns. And that becomes the challenge right now, is how do you get creative in finding that value? As you mentioned, when you're looking at these value add projects, for example, that are trading on a 3.5 cap, for anybody that's listening, that if you have any experience at all, buying properties on a 3.5 cap means that you're probably not cash flowing quite a bit. And then when you're looking at value add and you're injecting $2-3 million of CapEx into a project, you're now paying a premium up front for the potential to add value. And it puts that pressure on you to now that you have to go and perform at a high level to make sure that you can meet those returns. And I'm going off a little bit of a tangent here. I'm sorry, I'll get back to your question. But the point is the underwriters have a tremendous challenge right now in this market cycle. So,
are you about to start a podcast or producing a podcast and tired of doing the editing yourself? We have produced over 1,000 daily shows, and the production team that I've created, they're now available to produce shows for you as well. We can do as little or as much as you need, from finding and communicating with guests, preparing introductions, to editing the audio and video. You will sound better, have a more professional presence, and be able to spend your time doing other valuable tasks on your business. Let me know you're interested by emailing me directly at whitney@lifebridgecapital.com. I think it's numerous things you mentioned there are so important, but you said like understanding their market dynamics and fundamentals. It's crucial, right? You talked about like the massive rent growth, from 5% to like 16% or something crazy. Mm-hmm. And it's hard to, how do you even project what's going to happen the next year when it's not like this steady increase, right? And there's no way to, know exactly what it's going to be. And we've never known exactly, right? But then you talked about you must precisely determine, right, the value to acquire the asset at. Walk us through a few things that's going to help you to do that.
Sure.
What are some things that you need to know about an asset maybe you're looking at today in your market that's going to help you to be more precise as far as assessing the value?
I think historically, most underwriters would probably argue that they try to build in some type of contingencies in their underwriting to make sure that they can conservatively, and I hate that term now, conservatively approach their analysis. But I think right now, when it comes to precision, you really have to look at tightening up your economics. So if I'm in a market that is really giving me, let's call it a physical historical vacancy rate of 6%, I'm going to underwrite to 6%. Now there's other things that go along with that, bad debt, concessions, things like that you have to factor in. But the point is, you may build in, hey, I'll underwrite to a 90% occupancy. And if the deal works at 90%, cool, I have a great deal. Well, although we'd all love to be in that world today, you're basically underwriting yourself out of an opportunity. You can't be competitive at. So being very precise and on what the market's giving you and factoring that in. And I start with looking at not just the physical occupancy and the economic vacancies and such, but looking at the rent roll. What is the lease trade outs on the last 30 to 60 days? What type of rent premiums are they getting on those trade outs? And that's a good indicator to me on what is the future projected performance moving forward into the next, call it year one projections. That's a great indication there. And then that can help you also determine, all right, well, how much CapEx do I need to go inject into this property to really be able to capture that premium? we're seeing, like I said, we're seeing opportunities here in Houston where properties, I just toured one last week, as a matter of fact, 21% rent increases on their lease trade outs in the last 30 days. Now, am I going to model that 21% for year one? No. But does that give me a benchmark on the demand for the product and what the product can absorb? Absolutely. And so looking at things like that, getting creative in creating other value, looking at other income items, fee structures, looking at new amenities to add to the property aside from just cosmetics. I mean, most of these properties have been traded hand over hand for the past several years. Every couple of years, it's a new operator group coming in. And so everybody's doing this typical value add, granite countertops, new cabinets, blah, 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 you name it. So, what are some other ways that are just not the, bread and butter value add strategy? We're very big on prop tech right now. For a few years back, probably a little bit ahead of its time. Now I think it's becoming a standard. People want a more efficient home. So, looking at prop tech is a big one. Looking at other amenities like washer dryer connections, if you're looking at the value add space, people would prefer to stay in their apartment homes and be able to do their laundry care inside the home versus going to a laundromat. Things like this is something that we've looked at too, is we're more in the core plus product space right now. We really like that, especially with everything being on a premium, but electric car charging stations. And, just trying to think of different ways to be creative and offering amenities that no other properties are offering. And although some of those things may not directly drive immediate revenue to your property, like in your underwriting, what it does do is it attracts a certain tenant demographic, right? It attracts a certain renter profile that now, could be able to pay a higher rent premium or whatnot. And so, like I said, just being creative in that. And I'm sorry, I'm going off on a tangent again.
No, these are some really good points. That's why I want to let you go there a little bit, because it's, like you had mentioned it earlier. You said like getting creative at finding value. And then, now you started listing some of those things off. When you say prop tech, what is that? That could be a brand new thing for some listeners.
Yeah, those are things like your keyless entry, your smart thermostats, your adjustable light switches, or things like that. A lot of people are doing the Alexa or Google Homes inside apartment units, things like that. The modern technologies that we all probably utilize in some form or fashion in our daily lives that are now being incorporated into the apartment home. And a lot of people historically would think, oh, that's for the Class A product. That's for the Class A demographic. And I would argue that is not. Your lawn guy outside has a smartphone, and he wants to be at home and he would love to have bulk community Wi-Fi in his apartment home. Think about that, to have free Wi-Fi in your home and have a better service just gives them a better experience. And that's what the focus really is about right now is how do you enhance the resident experience through those, creative amenities that you're talking about with prop tech.
Also wanted to ask you about, you mentioned a core plus type product. What does that mean? I know that's something we talk about often in our industry, but there's probably people that don't understand what that really means.
Yeah, so that's basically your newer vintage product that has a better amenity set that appeals to, a more, not necessarily affluent demographic, but a higher income earning demographic. And so those are your, for us, call it 1980s, 1990s vintage or newer. So not quite as old as the 60s, 70s product. Again, has more of your modern amenities, hopefully, ideally, even modern finishes throughout. And the thesis behind that is, as you mentioned earlier, right? Your value add projects, the 60s, 70s product is trading at a 3.5 cap. Well, guess what? So is the core product. And so there's no delta anymore between the value add premium and the core plus premium. So we figured, if we're going to pay that premium, we might as well go buy the newer, better buildings that don't have all the CapEx headaches that come along with them. So
it's interesting. You brought up a minute ago, and I don't believe that I've heard anybody talk about this. I may have seen them at some communities, but we've not talked about it on the show, is the car charging stations. You mentioned something about this as well that makes a ton of sense. It's like, it's not immediate value, right? There may not be anybody in the community at the moment that has a electric car. Right. However, you mentioned that, that bringing a different demographic, in to your place because you have that specific thing. Speak to like when you would consider using that and maybe how long until you've seen an actual value in that.
Yeah, it's a great question. And it's newer concept for us. And it's something that we're just in kind of concept more so than implementation, but we saw it on a couple of other properties that we toured here locally. And so the question is when to implement it. That's a great question. I don't know that I have a direct answer for that. But again, the thesis behind that is how do you differentiate yourself from your competitors? If you're looking at a property set or comp set that's all very similar in vintage and amenities, what's going to differentiate you from the next guy down the road, aside from rent premiums or concessions? Well, being creative and, like I said, offering things like that, which we all know the movement towards green energy, electric vehicles are becoming more mainstream, not just Tesla, but now your major car manufacturers are putting out some type of electric car product that are very affordable to the general, middle class demographic. And so just thinking about things like that are, just unique ways that you can differentiate yourself. So, we're looking to add those things on immediately when we're taking over a community. We just acquired a property here recently, and that's discussions that we're having now. Now we're working through who do you even go to as far as a supplier and what do those costs look like? I mean, we're still working through those things. But again, the thought is if you can bring in a certain type of resident demographic, then that's ultimately going to help boost your business plan. So, but you want to be proactive. You never want to be the last of the market trying to do something. So, but you also kind of don't want to be the first either. So it's kind of finding that middle ground as far as, when to implement those things. But I think again, that goes back to understanding your market, understanding your demographic, and what opportunities may lie when you're looking to incorporate those things.
Knowing your market and the local demographics, like you talked about, speak to do you have any predictions for the next 6 to 12 months? I mean, if we could even have any, but what are you thinking? Are you all moving forward buying? Are you just looking to sell, or kind of where are you all at in that?
Yeah, Whitney, I think this year's still a phenomenal time to buy. It's getting increasingly harder. It's definitely much more difficult to find opportunities, especially at the premiums that we're paying. And now you're having to be more aggressive up front, not just from the underwriting and pro forma projections, but on your offer terms. You're talking about a significant amount of hard money, 6 to 7 figures in some cases, things like that. And those are very uncomfortable moments where you're having to wire $500,000, $1 million hard day one, knowing that no matter what happens, it's never coming back. But having said all that, I think it's still a phenomenal time to buy this year. I think we're definitely moving away from cash flow more so than looking at appreciation. And that may not be very settling for a lot of people listening. But the reality is, especially if you're looking at primary markets like where we're at in Houston, San Antonio, markets like that, I mean, the days of 8% cash on cash just really aren't there. We're looking at tighter yields, but still aggressive appreciation. So I think now's the time to get in, be active in your markets, be looking to acquire as much as you can. But I think you also need to anticipate longer holding periods. I think we're moving away from trading deals every 3 years to now you may be looking at actually holding a deal for 5 to 7 years throughout its full life cycle based on your performance. But, a good friend of ours has said this, you can find opportunity in any market cycle. You just have to know and understand the dynamics of that market cycle. So I would encourage everybody to keep buying.
So you mentioned some expectations that probably should change, right? Where we need to start thinking we're going to hold longer. That it's probably not going to be that 2 to 3 years like we've all grown accustomed to over the last few years recently. But then also maybe our cash on cash or our returns are going to be slightly less. Speak to anything else that maybe expectations that maybe we should be conditioning our investors for, or thinking through even our own operations, right? Of what to expect, maybe that you all have changed, how you're looking at deals.
Yeah, that's a good question, Whitney. Aside from the return expectations and whatnot, I would argue that looking at experience is going to be important. Again, it seems very rudimentary, but I think this is the age of the operator. You had a lot of guys coming up over the past few years that maybe have not been great operators, but still performed very well just because of the market, what the market was able to deliver. I think, again, with us buying everything on a premium, the margin for error is so much thinner that, the good and bad operators are really going to be distinguished. So I think really looking at experience is going to be really critical right now in the operators that you're partnering with. But I would anticipate and I would expect investors to really expect maybe a longer term position in some of these deals and just be prepared for the long haul, because I think that's what it's going to take to really execute these full, business plans.
I just think it's helpful for operators to know that too, as you're speaking to investors day in and day out, like building, that expectation, right? From the beginning. So, hey, I just need, the investor to know upfront, we do say say 5 to 7 years for a reason, and don't expect it to be 2 years, and so often investors say, well, when can I get my money back? Or if I need out, if there's family emergency, these things. So we just try to stress it is not a liquid, investment, and let them know that. So just to set proper expectations. So, when you're underwriting these deals, how do you say prepare for a downturn? Let's say worst comes to worst, the worst happens, maybe you're prepared for that, but then two bowlers go out at the same time and, there's like 2 or 3 things happening here. How do you prepare for something like that?
Yeah. So what we do is we take every offering, and it's kind of funny with this market cycle. If the broker gives us a price guidance, we throw another 5, maybe 10% on top of that, because that's really where we know it's going to trade at. And then we underwrite it to that and say, okay, what is it going to take economically for this asset to perform at that valuation throughout our business plan? And then what we do is we put it through a series of stress tests, everything from looking at economic vacancies to capital market downturn. So if we're buying on bridge debt, what does a refinance scenario look like with a rise in interest rates here 2-3 years down the road? If we're on conventional, what does that look like if we have our yield maintenance or defeasance, prepayment penalties, and we want to exit sooner? And then looking at things like cap rate contraction. Although I, for one, believe that we're still going to see cap rate compression. You still have to anticipate the unknown. So what happens if, we're looking at a different cap rate environment a few years down the road that may not be so favorable? So underwriting and stress testing the deal at multiple different scenarios to see if the deal can weather those storms. And then in addition to that, to your point about, what happens if boilers go down? We bake in a lot of extra reserve contingencies in our underwriting. So we have operating reserves that can cover, 1 to several months of operating expenses. That includes all of the operating expenses plus debt service, deferred maintenance reserves, capital reserves for the lender for whatever reason. So we just bake in a lot of extra reserves, which does make it more challenging because that means it's more capital you have to raise. But that's a very easy story for us to sell to our investors when we say, hey, we're building in a layer of protection just in case. And that may mean, okay, your cash on cash is affected a little bit, but at least there's a security blanket here that we're using to prepare for those downturns. So those are some things that we do that work really well for us.
Man, you sleep better having that cash in hand, right? When it's like that emergency budget, no doubt about it. You mentioned these different types of emergency budgets, or and you said 1 to more months. Is there a way to do you have a way of saying like, okay, 6 months of our expenses, or is there 3 months, or some way to, I don't know, roughly? So I was trying to think for the listener to know, hey, we should plan, or Cody plans on this kind of reserve budget or anything like that.
Yeah, ultimately, it's up to you as the operator. I mean, you have to figure out what that comfort level is and how does that impact your business plan. I mean, look, ideally, as operators, we would love to have 6 months worth of operating reserve set aside. But again, that could equate to raising another $1 million or so in capital, which could kill the deal. So you kind of have to find that balance. For us, we're looking at no less than 1 month of operating reserves. But ideally, if we can stack up maybe 2-3 months worth of operating reserves, that kind of gives us a little bit more comfort. So, but again, it's ultimately up to you as a team and an operator team to find out really what you're more comfortable with. But the more that you have, the better security that you have. So, just something to think about.
What about your best source for meeting new investors right now?
Networking events. Between networking events and social media, my partner Brian and I, we joke, we're kind of the faces of Blue Up Capital. We're all over social media, so we're looking to engage as many people we can. We're at every networking event that we can be. Very disappointed we missed Best Ever this year, but we'll definitely be there next year. But I definitely think getting face to face, especially in this post-COVID world, has been so impactful for us. Just being visible and present in all the communities. So.
How did you learn to underwrite?
Oh, good question. I would really say engaging with my property management team, having no familiarity with underwriting and what that even meant. I found a basic underwriting template that I could digest and understand, especially not coming from a finance background. I wasn't very well versed in Excel. Taking a rent roll and financials from a property and then really working with my property management teams in that area and looking at their underwriting and their budgets to really kind of help me develop those skill sets. And I encourage everybody to do the same. And I would also encourage people too. A lot of people are looking at smaller multifamily deals. I would encourage, if you're just now starting out underwriting, go look at the bigger opportunities. Go to the broker list, find the 100, 200 plus unit, and pull those financials off. And even though that you're not going to look at those opportunities per se, what you do have is a professionally operated community. Professional management. Your profit and loss statements are much more clean, usually, and they're just more legible. And that helps it to be easier to digest the information on those rent rolls. And so I would definitely start with that, take those, and then work closely with property managements in your target markets. And again, understand how they're underwriting and how they're creating budgets. And that'll really help you start putting pieces together. What
are some daily habits that you're disciplined about, Cody, that have helped you achieve this level of success?
I operate by my calendar. Everything has a time block on my calendar. If it doesn't exist. And so I live by my calendar, and I try to stick as closely to the calendar and the time blocks as I can. I think starting off the morning with some type of self-improvement is great. So I do a lot of like yoga, stretching in the morning, things like that. I really love starting off the day with that. It just kind of helps get me in a good mindset and just kind of my own little quote unquote meditation, I guess, so to speak. But just doing something to start your day off with, taking care of yourself first, that puts you in a good headspace and before tackling the day. And then, between those two, that's my two biggest ones.
What's the number one thing that's contributed to your success?
Partnerships. Having two great partners that we can, divide and conquer. There's so many responsibilities in this business, and there's so many hats to wear. And even between the three of us, it's overwhelming sometimes. So, but man, I couldn't do this without those two guys behind me. So
how do you like to give back?
So we like to leverage our platform to help impact our community. So we have a local meetup event that's live, in person, and virtual. And what we did this past Christmas is we actually used our networking community to come up with a toy drive that we could donate to a children's charity in our community. And now this year, what we're doing is looking to do things like the backpacks for school-age kids for the next school year, and other different community events that we can do at both a community level and a property level. And so just really leveraging the platform that we have to give back and find ways to positively impact the community. I think it's prudent of us to do that.
So from accidental landlord to 847 units, over $100 million multifamily. Congratulations, Cody. I'm just grateful for your time and your transparency, and even just diving into some of the underwriting side, or, your underwriting model, the business, and what we should be thinking about right now as far as this market, what dynamics, and just how to be competitive. Thank you again for your time. How can the listeners get in touch with you and learn more about you?
Yeah, thanks again for having me, Whitney. This has been such a great experience and pleasure to be here. But you can find me on social media. Facebook, LinkedIn is where we're most active. If you want to reach out to me directly, you can find me at Cody@blueoakinvest.com. And then would love to connect with you there.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com, where you can start investing in real estate today.